we are starting in more or less 1 minute, ready to go in just a moment, okay? Hey everyone, just saying hi, we are starting. Okay, everybody, welcome to the session, everyone. We are now getting started. Today is October 27, 2022. This is the SMARTT Tiger Live trading session. It's SMARTT with double T, which stands for Tiger Traders. So we're going to do a special market analysis report for Tiger Traders. That's the meaning of SMARTT, but also that report is going to be smart because we look at options data, and talking about options data and options trading. So we also have a lesson, like every time we do Tiger Live with me, and we'll go over options pricing models today. My name is Jose Blasco. You can see my email on the screen. You can also see our social media handles, Trade with UFOs in Instagram, YouTube, Facebook, Twitter, etc. So you can find us there, and just take a look at what we do and follow us and everything else. Before we get started with the meat of the session, we have a disclaimer on the upper left side of the screen. Please read it carefully. It's fairly short. I guess it's fair for me to request everyone to read it completely because it's important information, and it's there for you on the upper left side of the screen. So please take a moment so you can read it. And with all of this said, the session really is ready to begin with it, and we're going to start. One more thing, while I give you a bit of extra time to read the disclaimer and also to get organized. I am watching you, my friends. That means I am watching the chat box on the Tiger Broker apps, but I am also watching the chat box on YouTube for the ones of you attending the sessions directly on YouTube. So just make sure you interact with me, make sure that you are engaged, make sure that you ask questions. Again, certainly I can help you better if I understand what is it that you need, and I will do that if you interact with me. So do not be shy. This is a session for us to learn. Thank you, Tiger Brokers, for organizing this. And you guys, make sure you seize the opportunity by simply asking questions or making comments about anything related with the topics today. Or if there are certain topics that we are not discussing today, but you would like to learn about something specific, make sure you mention that so we can build specific sessions in the future to talk about that. Okay, so happy to help. Do not be shy. Counting on you. Let's try how shy you are. Can you all type on the chat box hello? Even though some of you already typed, go ahead and everybody types hello. So it's a nice way to get started, and that way we start warming up those fingers. So the sequence for today, okay? So we're gonna have a quick introduction. I'll talk about who I am as a trader, very quick because this is really about you, not about me. So I'll keep it short, and then from there we'll talk about headlines, what's happening in the markets, and from there we'll move into our lesson. We'll do the commentary. I have a bonus for you, as we said before, and from there Q&A. We can keep it to the end, but to be honest, I think it's better that you ask questions as we go, so the questions could be more in line with the contents for today, okay? So again, do not be shy, and thank you for those hellos, everybody. It's very nice, very kind. Jinhan, Bobet, EE, Bidadari, Madam, everyone, many names are there. So thank you so much, everybody, for participating today. Anyway, so introductions, very quick. Who is Jose Blasco? Well, that's me. I am a multi-asset trader. I trade all markets. I have to say options is my favorite. I have something special for options, maybe because my background is engineering before I became a trader, whatever that is. The fact that options give you options, the fact that you could trade one contract at a time, or you can do combinations of contracts, do what is called spreads or multi-step option strategies. So the fact that you can do all of these things, which cannot be done with other markets, it's really something very special. So options give you options give you choices. I think we all like that, and that's where my real passion in trading comes from, even though all assets are indeed very powerful. I also wrote a book, as you can see on the screen, etc., etc. But really, what you really need to know about me is that I am very passionate about trading. And I used to be a university professor, so I am also very passionate about lecturing and teaching and helping others. So again, count on me, guys, and be interactive during the session so we can make it count. I also represent tradewithufos.com. This is the brand that our company Tradictive utilizes when directing their message, our message to traders like you. So trade with UFOs means that we trade with on-field orders. UFOs stands for on-field orders, and when we use that on the charts, which later, by the way, you will see me use real-time charts, so you will get to see it. But when we use that on the charts, they look like flying saucers, as you can see on the upper right part of your screen. So they look like those round circles, okay? And you know, so they look like UFOs, right? So and we call them UFOs because it's the acronym, and they look like that too, right? So the key is that those UFOs give you an edge in trading. They help you to set entries and exits, or when you trade non-directionally speaking with options. So you can also set price ranges, and you know, it makes you mechanical, makes your life simpler, save you time, and all of the above. Okay, but anyway, you can find out more information about all of this on our website, and certainly shoot me an email if you have questions. Again, later I will jump into real-time price charts, but before, let's begin with the headlines. So the headlines, to be honest, we could make up headlines every day about a million things that may be happening out there in the world. The reality is that the market tends to not to care too much. The market, for every trading day in the market is a trading day, unless something extremely extreme happens. You know, the news are just, you know, things that happen. So instead of talking about a million of different things where you could read about it, you know, in all those websites. So instead, I'm just being very pragmatic here and just pointing at what's key, right? And what's key is, as we know worldwide, things are not too well. Things are pretty bad, actually, between Russia, Ukraine, geopolitical tensions in other places too, the impact of what's happening in Europe, which is propagating into other places in the world. And for sure, that is a news which is not new, but certainly still impacting the market, and potentially more to come, and potentially surprises to come if, God forbid, you know, a nuclear weapon is used, or some crazy other crazy events take place. Next thing you know, the markets are going to react to that in a major way. So this is something, looking at the markets from a pragmatic point of view and headlines from a pragmatic point of view, we cannot forget that this is happening, even though it's been happening for months and people tend to forget or talk about it less. That's out there, and that's relevant. The US fighting inflation and raising hikes, and many other countries doing the same. It's also nothing new. It's been happening for months and months, but it's also very relevant. Like, let's say next Fed announcement happens to be a surprise, and they don't raise interest rates where everybody's expecting them to raise. Wow, that may create such an impact in the marketplace. So again, those are things to never forget. It's happening, it's out there, and while it's not new, even though the title of the slide could be news, really it's not new. But it's extremely relevant. Everything else is really not relevant, but this is very much relevant. And then finally, and that's probably the most relevant of all, the fact that the US dollar has become such a strong currency in 2022, it was driving all markets out there. So we can see how the US equity markets are going up since a while ago. And that, you know, many people may say, no, it's because companies are reporting earnings. It's because blah, blah, blah. And again, of course, I hope I had a crystal ball and I know exactly the reason why things happen in trading. I mean, no one knows. You can always, you know, everybody can have theories, but knowing for sure is a different story. And certainly, if any, you know, after the fact, not before. So, you know, there may be many people, many professionals explaining their view, but no one knows for sure, right? So now, what's for sure happening, and that's why the US dollar is very relevant, is that when you trade stocks, for example, when you trade commodities like oil or gold, those markets are priced in US dollars. So because the US dollars became so strong, next thing you know, you need less of those dollars to buy stocks. You need less of those dollars to buy commodities. Why? Because the dollar is stronger. And therefore, what happens to the price of things is that they go down, because with less dollars, you can buy it, given the fact the dollar is strong. So that's such a powerful force, which was not so relevant. It's always been very relevant, but it's been less relevant, if you wish, before 2022, since the dollar was behaving, let's call it normal. But in 2022, the dollar is behaving in ways that are, let's call it less normal, statistically speaking, given the fact that we reach all-time high but that's not properly said. It's not all times high, but it's the all times high in the last 20 years, more or less. So, I mean, surpassing the highest high of the last 20 years, I guess, is quite relevant, isn't it? And this had an impact in the markets in a major way. And what's happening now is that the dollar is weakening a bit. And because the dollar is weakening a bit, we can see how equity markets and other markets are going back up. Okay, so we're going to do our SMARTT analysis later, where I will move into the live charts and get deeper into the content of these market analyses. But keep in mind that the dollar is a driving force helping the equity markets to go back higher. Okay, even though many people will blame it on earnings, like today we got earnings, we got 752 earnings being reported today. So it's a very important day, and maybe the market gaps up, and next thing you know, you're gonna see all the news out there is gonna be, it's all about earning, right? Again, probably you look at the dollar and you will see the dollar going down if that's the case. But anyway, very important day from an earnings point of view, and within relevant, I pointed here at Apple, Intel, Amazon, McDonald's, and Twitter, like extremely relevant companies. Many of those, as you can see, not all of them, definitely not McDonald's, but many of those belonging to the technology sector, which has been beaten in a major way worse than the S&P, the NASDAQ, which is the technology sector, if you wish. I mean, there's also biotechnology and other minor industries, but it's basically tech. So the NASDAQ has been beaten very badly, more than any other US index. So in that sense, the fact that today we got many earnings reports and many are those very solid companies. So it's something to watch for, and especially if you're invested in those companies, okay? So so this is what's happening from headlines, from a headline point of view. Again, keep in mind what I said. I am very pragmatic. I tend to talk fast, and I actually tend to talk a lot. But I don't like to get into, let's call it gossip of the market, which is, noise and things that people talk about that they have no, statistical relevance with price movement. Okay, so I'm being extremely pragmatic here. So with that said, and before we move into the market analysis, like in a proper way, we have an options lessons to cover. So let's do that, and then we'll come back. Okay, so I would love to get some initial feedback from you guys. How is it going so far? I just said I talk quite fast. On top of that, as you probably feel, English is not my first language, meaning I have an accent. Is everybody okay with my speed? Is everybody okay with, my accent? Everybody okay? Anyone has a question? If all is okay, just type okay, please. Even though you may feel it's not needed to type okay because it's okay, it really helps me a lot to understand if you guys are with me. So please go ahead and type a quick okay if that's the case, and if it's not the case, let me know. So the lesson for today is about options pricing models. Okay, there are various options pricing models. What are they? Which one to use? What is it that matters the most? Why is it important? Is it that important or is not that important? So let's talk about it. Let's talk about what are options pricing models first, and from there we'll dive deeper and deeper, one step at a time. And thank you so much for those confirmation, Edeline, Bidadari. Thank you so much, guys. That's really, again, I so appreciate that. It's so cool to have a conversation with you guys instead of having a monologue with myself, okay? Thanks a lot. So pricing models, okay? Well, options prices derive from the underlying asset they represent. That's nothing new. Options prices are also impacted by other factors, such as how much time we got to the expiration. What strike did you select, right? Are you buying the 100 call or is it the 150 call? So that impacts the price of the options. What are the interest rates, okay, which are changing, right? So what are the, is it high interest rate? Is it low interest rate? This would also impact the price of the options contracts that we trade, the calls and the puts. What is the expectation for the future movement of the underlying? For example, are you buying a call before earnings, or, are you buying a call after earnings? So what's the expectation for the movement, right? Which is called the implied volatility, right? We talked about this in prior lessons. So all of these impact the prices of options. Options pricing models, they help calculating what is a fair value. That's what the pricing models are used to do, right? I mean, we can use them in different aspects, in different applications, I meant to say, But basically, in the end, is what's the fair value, what's the theoretical price of an option if the price was to be fair based on a pricing model. That's what the pricing models are for. Okay. Now, because we can calculate the price of the option now, the fair price of the option now, but those prices are made of things such as, the expiration date. So you could also, within the model, you can also vary the date, and next thing you know, now you can project into the future what the price of an option will be or should be if it was to be fair, in case of the stock goes up, or in case of the stock goes down, or in case the interest rate vary, or in case the expectation of price movement changes. So now you can play with the what if scenarios into the future, changing the what if reasons that changed the prices of options. So it becomes options pricing models are extremely useful, because instead of you buy a call and now you have no idea what to expect into the future, the call price will change, but you don't know what to expect. So now you can actually simulate. You can actually run a simulation and predict, again, assuming everything is going to be fair, fair as defined by the pricing models, which there are many different pricing models. So you can now predict how much is it that I'm going to lose if I'm wrong, and the market goes, the stock goes to this price point into a future date. How much is it that I'm going to make if I'm right and the stock moves to that price point in a future date? So again, pricing models are absolutely key for us traders. And by the way, it's computerized, so the computer, your mobile app will do the job. And now you can understand what to expect from options. Okay, you can also calculate the options Greeks, thanks to the pricing models, which obviously those are we had lessons in the past on options Greeks, and it's critical. If you were to trade options without Greeks or without understanding the Greeks, it's like you drive a car and you don't know what is the speedometer. You don't know, you don't know where to check to find out if your tank is full of gasoline or empty of gasoline, right? So you would have a problem as a driver if you didn't know where to check the various variables that tell you what to expect from your car if you're a driver, or the various variables that tell you what to expect from your options trade if you're an options trader. Those are the Greeks. So again, pricing models we cannot live without. Okay, now the rationale behind all pricing models is the fact that options data always depends on probabilities to move by a certain amount or not. Okay, so that's the thing. Okay, so you buy the 100 call, let's say the stock is trading at 90 and the call has an expiration date and has a price today. That price has a lot to do. It's really all about what's the probability of that call to have value on expiration. And the only way that call has value on expiration is that the stock has moved enough. The stock has moved by a certain amount, which is enough for the call to have value on expiration, which is when the call is gone. Because if the stock hasn't moved enough and the call is gone, it means that everything you paid for is gone. But if the stock has moved enough to make the call to gain value, so then you make a profit on expiration. And of course, the higher the probability of that profit to be made, which is the same as saying the higher the probability of the stock to move enough, then the more expensive the call, the less the probability for the stock to move enough to make that call to have value on expiration, then the cheaper the call, right? And the same happens with the put. So again, the more likely it is that that move will happen, the more the price of a contract, and the less likely it is, the less the price of an option. The certain amount refers by, one more time, moving enough to bring an options contract that is out of the money to become in the money, or a contract that is in the money to remain in the money. In other words, you reach expiration and there is still value, versus you reach expiration and the whole thing is gone. That's the rationale behind options pricing, and therefore options pricing models are obviously thinking the same way. Okay, so it's all about that. So the greater the probability of an underlying to move in a way where the options contract will be in the money on expiration, the higher the premium, and vice versa. So it's all about probabilities. To be more specific, it's all about the probability of ending up in the money, and this impacts everything. So the price of the options contract, therefore the values for the Greeks, everything in options pricing is depending on the probability of ending up in the money. Okay, that's what it is. That's the bottom line. Okay, so now how do you calculate that? How do you calculate that, right? Well, yeah, there are different pricing models. The following are the most common models, the three models you see on the bottom part of the slide: the Black-Scholes model, the Binomial model, the Bjerksund-Stensland model, difficult to pronounce for me. So those are the three classical models. There are more, and there are also some models which are variations or tweaks of these three models. Okay, so again, there is a vast array of models, but they all come from the same angle, which is the probability of an options contract to be in the money on expiration. Some applications of those models may be exactly the ones defined by Mr. Black and Mr. Scholes, if it's the Black-Scholes model, etc. And as I said, some of them are variations. So let's look at these three models one at a time. The Black-Scholes model was developed in 1973, and Mr. Black and Mr. Scholes were granted the Nobel Prize of Economics in 1997 for this work. It took a while, I guess, since 1973 to 1997, but basically they were granted this Prize Nobel of Economy. That's certainly something to brag about, isn't it? Not a joke. Mr. Black and Mr. Scholes did something extremely smart, but at the same time, it was also the time where options trading and the markets in general were simpler than now. What do I mean by that? Well, the Black-Scholes model assumes that all options contracts are European style. What's that? Well, in options trading, there are two styles of options contracts: what's known as American style and what's known as European style. So what's the difference? Well, the difference is that with European style contracts, exercise or expiration is not something that you can request during the life of a contract. So if you buy a contract that expires in 30 days from now, and it's a European style option, for example, options on the SPX, which is an index. So you buy SPX options, they are European style. Or for example, with Tiger Broker, you can trade nanos, okay, which is SPX nano options, okay, very tiny options, which are very nice to learn, to be honest. It's every $1 move, you make $1, you lose $1. So it's super tiny, it's called nanos. So those options are European style. That means that even if you buy a nano that expires in 30 days from now, or an SPX option that expires 1 month from now, you can buy it and you can sell it anytime. So you can trade it anytime, including intraday, but you cannot use your right to exercise until it expires on the expiration date. And of course, because it's already expired, then you cannot use it. So it's automatically exercised or automatically assigned if it's in the money. So you cannot control it. And because you cannot control it, then it tends to be a bit cheaper. The American style options, it's basically the same story, but it's an option, calls and puts, but you could choose to exercise prior to the expiration date. For example, let's say you own a call and the stock is moving your way, the call has some profit in it, and the stock pays dividends tomorrow. Well, if you own the call, you won't get paid dividends. To get paid dividends, you need the shares. But the stock is not yours. You own the call, not the stock, right? And let's say the call expires 30 days from now, so you won't get stock delivery until 30 days from now. Guess what? You could connect with your broker, either on the app or on the phone, and you can tell them, hey, please exercise my call. I want the shares now. Well, with American style option, even though you got 30 days to go, whatever amount of time to expiration, you can exercise now. You don't need to wait until expiry. That's American style options. With European style options, you have to wait until the expiration date. Okay, so stocks in the US are all American styles. Okay, ETFs, majority American style. Indices, most of them European style. So in other words, the Black-Scholes model that was created probably at a time where the majority of derivatives were European style. So that Black-Scholes model was a fantastic invention and very useful. But guess what? Later in time, American options were born, and actually 9,000 stocks in the US, out of them 6,000 are optionable. 6,000 stocks got options that are American style, and the Black-Sholes model doesn't know how to calculate that. So in other words, it's a good model. They won the Prize Nobel of Economy, but at the same time, it doesn't calculate American style options prices in a fair manner, in a good manner, because it's not built in the model. Okay. So now also assumptions, no dividends are paid. So because it was indices, there were no dividend payments, right? So then no dividends are part of the model. And also the assumption is that interest rates are constant, volatility is constant, which, let's face it, things tend to not to be constant. Okay, volatility changes, interest rate change. So it's a very powerful model. It's very powerful. It's amazing, to be honest, from a mathematical point of view, but probably not the most adapted model to the modern markets. Okay, now having said that, there are many platforms, okay, that will tell you, hey, we use the Black-Scholes model, but guess what? They tweaked it. Okay, brokers, Tiger brokers, for example, those people are smart. Okay, so what do? They take the Black-Scholes model and then they do some add-ons to make it a bit more adapted to the reality of modern markets. Okay, so just know that most of the platforms that tell you we are using a Black-Scholes models, most of the times is a tweak. Okay, even though some platforms may still use the classical, or maybe you use a spreadsheet like Microsoft Excel, and you use some sort of Visual Basic code to calculate your own Greeks. And careful, because you may be using a Black-Scholes model, which is the classical Black-Scholes model, and then so it's not adapted to European style of dividends. Okay, so remember that. Bjerksund-Stensland Model was developed in 1993, much more modern. It's applicable to American style options. Okay, so that's great. But now, of course, if you trade SPX options, which are European style, maybe now is not the best choice. And the assumptions here are dividends are constant, interest rates are constant, volatility is constant. Well, again, when you do your simulations, it's fair enough to assume that everything is going to be the same. The reality, things move. So again, I would say it's a much more advanced model, probably much more adequate for stocks, but still many of the brokers that implement it, then they may have tweaks, maybe where they look at dividends like as a variable instead of a constant, and things of that sort. Okay, and finally, we have the binomial, which was developed in 1977. And here again, it applies to American style options, so very adequate for stocks. And also, in this case, dividends are not constant, interest rates are not constant, volatility is not constant. So probably is the most adequate of all, or the most advanced model if you were to use the kind of like the standard model. It's probably the most advanced, but again, it's American style. So if you were to trade SPX options, so it's not the most ideal because SPX options are European style or any other index options. Okay. Again, the majority of brokers, the majority of apps, Tiger broker apps, for example, most of the times they have some smart tweaks that the developers, the technology department of brokers have worked on tweaking a little bit the model here and there to make it as adapted to the reality as possible. And when calculating Greeks, calculating fair values, they get as close to reality as possible. That is why if you were to compare, like, for example, a free website where you got the Greeks, and then you compare that with the Greek values that you got on the Tiger broker apps or on our own software top, you will see slight variations because all of us, there are no two companies that are using the models exactly the same way. We all tweak them to a certain degree, and we may use a different model too, and in the end it creates slight variations. Okay, now notice I said slight variations, so it's not a big deal when you see those variations. Okay, the real deal is if the stock moves your way, you're going to make money. If the stock moves against you, you're going to lose money, no matter the model, right? So which, by the way, brings me to a very important point, which is no matter the model that you use, no matter the broker that you use, no matter the software that you use, no matter the website that you use, in the end, my recommendation, if I can throw a little bit of a recommendation out of experience, is that don't trade only based on what you see in the model. Like, for example, there are options traders that the only thing they do is trade based on the Greeks. For example, you sell options with a delta of 10. Okay, that's it. Why? Because delta of 10 suggests that you got 10% probability of being in the money, so you got 90% probability of being out of the money. So you sell an option which is 10 delta, and you got 90% probability of making money. So again, that on paper makes a lot of sense, but in the real world, it doesn't make sense, or it's not strong enough, I should say, because then you have all aspects such as technicals on the chart. Maybe there is an open gap below price, and gaps tend to fill. So while the Greeks tell you 90% probability of making money, the reality is that you only got 10% probability of making money, and maybe you are almost guaranteed to lose. Because you were not even looking at the chart, and you didn't know your UFOs or your support resistance levels and things of that sort. So again, the model, it's extremely important to use. We cannot trade options without a model. Thank you very much for the amazing mathematicians that develop the models, and for the amazing technologies that program the models in our softwares. Thank you very much. But then in the end, the slight variations you may find from model to model are not that important, because every time you trade options, you will likely be looking at, for example, if it's me, I'm looking at the UFOs, and then I plan my trade, and then I'm looking at the Greeks, and now I'm using the model, but in a way that is combined with the chart analysis. Okay, so yeah, that's basically it. Okay, so I'm going to move into the real-time charts now to do our analysis, and we look at the models there as well. But before that, I told you I have a bonus for you, so you can see it on the screen. Hopefully, you are taking you're scanning this QR code with your phone, so you can get to this link, predictive.com/top-coaching. This basically, it's a $63 gift for you guys. This will give you 3 months of free access to our coaching plan, and that means that multiple times a week we are doing live trading on our website. Today, actually, at 11 p.m., I will be running live options trading, and you are welcome to join me. But for you to join me on the website, you need a username and a password, and for that, you need access to a coaching plan. So here's a link that gives you free access for 3 months, and you can certainly come, join me, ask questions, learn from watching us professional traders do it. Not only me, I have multiple colleagues which are professional traders as well that will be also looking into trades. And as you can see on the screen, there is a calendar, and you are free to participate. And again, this is thanks to Tiger Brokers. Okay, so don't thank me for that. I mean, yes, thank me for that, but also make sure you thank Tiger Brokers. Questions there. What types of models are the market makers using? Beans, the market makers are using very, very, very advanced variations of models, which are customized for the options strategies they need to hedge against. So it's not even one model to make markets. It's actually per strategy. They use different models, which are basically helping them to have an edge, helping them to generate arbitrage opportunities and lock in profits and hedge risk. So when they make the markets, they don't get in trouble. So a generic model, even like, let's say you take the binomial, even if you tweak the model and you make it better, that's not good enough. In the markets we have these days, are amazingly efficient. I mean, it's unbelievable how efficient the markets are. I'll give you an example. Not too long ago, beginning of October, the CME, which is the Chicago Mercantile Exchange, launched a special type of options called event options, which is a binary type of options. A little bit of I use the word gambling is not totally correct, but kind of a binary outcome. Okay, you're right or wrong, that kind of thing. It's like black or red, that kind of thing. So now, very serious stuff, because it's in the CME exchange, is regulated, very serious stuff. But now, of course, what happens? New product being launched. So what happens? Those options are launched, and of course, smart traders would now be looking at, can I hedge those bets? Can I do binary options and use S&P options against the binary options and have some sort of an arbitrage opportunity? Guess what? Yes, for a day or two, I identify opportunities where you could make free money for a day or two. Immediately, the markets balance out, and next thing you know, arbitrage opportunities are gone. And why is that? Because those pricing models are totally customized per strategy, per market, per asset, per strike. Again, it's amazing. Okay, so the tools that market making utilizes are of a different level compared to retail traders or even professional traders, but also is a different job, it's a different activity. They trade with no commissions or very low commissions because they are clearing members, and their businesses are of volume. You know, they do millions of contracts a month, which are even professional traders would probably not reach millions of contracts a month. So it's a different animal. Okay, so long answer to your question. Very, very good question, Beans. Very good question. Carisdale, can give a binomial model application? Yeah, I will show you in a moment. The software that I use for my trading uses Binomial, so I will show you that in a moment. Okay, good. So let me do that. I'm gonna stop sharing the slides, so you will see me big screen for a moment, and the moment I am done with that, I will then be sharing my screen. So you will not see me anymore. You will only see my screen, and that way this will allow me to now move to, let me see, I'm just confirming I did it right. Yes, correct. Yes, it's all working fine. Okay, good. So you are now seeing my still my screen. Okay, but now it's not a PowerPoint slide presentation anymore. What you're about to see, you are about to see Top. Okay, so Top is our predictive options planner platform. Okay, so if I zoom in on the top here, it says predictive options planner. That's TOP, Top. Okay, so this is the platform I use to trade the most. I mean, not to trade. Let me rephrase that, to plan my trades, and then I go ahead and I use Tiger Brokers to execute. Okay, but to do my analysis, I use Top. Sorry, I did something wrong here. Perfect. So I use Top to do my market analysis, and then Tiger Brokers for execution purposes. Okay. So with Top, Top utilizes binomial. Okay. So when I launch an option chain, for example, I type McDonald's, and I load an option chain, and all those Greeks are being calculated and so on. Behind the scenes, it's using binomial with a tweak. Okay. So the thing about pricing models is that you cannot have like an application where, like, okay, because I'm using binomial, I can do something special that only binomial traders can do. Or because I'm using Black-Scholes, I'm going to do something special. No, as I said, this is going to give you slightly different calculations within the Greeks and prediction of prices or fair calculation of prices. But the differences are going to be subtle, because even the most basic model, which is Black-Scholes, typically will be tweaked by the brokers to be a bit more realistic. So all models tend to be very close to each other. Okay, so that's what it is. So let's do our market analysis. Okay, I believe we got 7-8 minutes to go before we conclude the session. So let's do this quick. So look, I'm looking at multiple charts. On the left, I got the SPY in a daily time frame. Okay, SPY in a daily time frame. On the right, I got the S&P 500 futures in a 34-minute intraday time frame. Okay, so now let's begin with the daily time frame. So what do we see on the daily time frame? Okay, well, on the daily time frame, we can see our auto climate, which, by the way, I granted free access to auto climate to everybody on the prior session. So you can go ahead and take a look at the recordings if you don't have it yet. And auto climate is telling us that we are in a blue climate. Blue climate means it's an up market. It's an up climate with a thick dot. It was not the case 2 days ago. It was a thin dot. So two days ago, the statistical analysis was suggesting an up movement, but no statistical advantage by going long. But today and yesterday, we got a thick dot, which suggests statistical advantage by being a buyer. So we've been in this climate for 3 candles, and a normal duration of this climate is 6. That's the normal duration of this climate. In other words, if this is the normal duration of this climate, we should expect another 3 days of the market going higher. Could that change? Of course. I mean, here you can see it only lasted 3 candles and it never became 6. By the way, it was thin dots. It was not thick. Now it's thick, so we have a greater chance of this to become a reality. It's all about probabilities, guys. Okay. So objectively, we can analyze what's going to happen instead of a gut feeling and, you know, just bragging about being lucky. We're just going to rely on probabilities, which is smarter to do. Again, probability suggests the market to continue going higher, okay? Now, the other thing which is very relevant is the fact that, and this is now when we're getting smart with double T at the end, we are now looking at options data. So the blue line, if you have been in prior sessions, you know, it represents the implied volatility of the calls. The gray line represents the implied volatility of the puts. And therefore, for the only way for the blue line to be above the gray is that we got either more buyers than calls than buyers of puts, or we got more sellers of puts than sellers of calls, or both. I said that very quickly, but it's okay because I explained last time. So in other words, this means there are buyers in the options markets. They are long traders. They are bullish traders in the options markets. This is happening since here. Since here, we identify buyers in the market. Now, this happened in a red climate. So what I was telling you at the time, if you recall, is be careful, don't buy yet. Buyers are coming into the market, but it's not time to buy. But the moment we change to blue, 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 with buyers in the market like we are having before or now, this is certainly a market condition which invites, from a statistical point of view, to find good buy opportunities with the stocks on your watch list, with stocks that belong to good sectors, etc., etc. So the S&P is now supporting, since 3 days ago especially, is now supporting a healthy environment to be a buyer of specific market opportunities that you may identify by yourself based on your trading plans, stocks that belong again to strong sectors, strong industries, etc., etc. But the S&P is now supporting it. It was a long time. There was a time where we got blue dots, but we had the gray line above the blue. So we had sellers in the market, and look at what happened. A little bit of a relief rally, but then it kept going, right? But what's happening now is different. We have an up climate with buyers on board. So very, very, and you know, we haven't seen that for a while. Very powerful market environment, and of course, mitigate your risk. You know, use stops, use define risk strategies with options when you trade, because I could be wrong. I'm just explaining what statistics suggest. Obviously, all my trades, and you should all do the same, should have a limited risk. You should have, you know, entry and exits defined in your trades, in case you're right, in case you're wrong as well, because we're not always right. We're traders. We're not, you know, visionaries of the future. That doesn't exist, okay? So make sure you manage your probabilities and your risk. But having said that, we have a strong market condition, which I'm happy to share. That's why I'm taking a little bit of time to explain it. I am happy to share because we did not have this type of market condition for a while, okay? And when it looked like it was the case, we had sellers on board, okay? So now, for the first time in a long time, this condition seems to be more stable. Now, this is happening at a time where the S&P futures are looking like they're going up and down, 0.11% down. That's why I'm looking at the intraday time frame of the futures. So I am anticipating what is going to happen to the equities when the market opens in 1 hour and 15 minutes from now. So very likely, we're going to see a small gap down, okay, which is probably some people basically taking profits from this pretty significant move to the upside from 350 to 380. That's not a bad move. And probably those people are taking profits, and that's why the futures are going down. But we have green UFOs below price. So if this market comes down and comes to the buy on field orders, the on field orders will get filled, and probably this price level, 37.96, is a relevant price point to keep in mind. If we look at SPY in a 34-minute time frame as well, we are looking at the equities now. So at 380, oh, sorry for that, guys. I just got a personal message on the screen. I'm sorry about that. So 380 is a relevant price point. Notice that the closing price yesterday was 382. The last price as we speak is 381. So in other words, 381.69. In other words, the S&P is likely going to up and down somewhere here, which is 381, somewhere here, right? So what I would expect to happen as the market opens is we're going to have a little bit more of selling pressure with profit taking, come to 380, and we have green UFOs on the S&P, also green UFOs on the futures, and from there, we are likely going to move back higher and continue this climate statistically for another 3 days. That would certainly be something very, very likely to happen based on my analysis here with the climate, the UFOs, and also options data, as I showed you on the bottom left part of the screen. Talking about options data, if we look at open interest, okay? So notice how we have a very, very large open interest right here, very visual, also located at 380. So we have open interest in the options arena, on-field orders on the underlying itself, in the context of an up climate, where we know that we have buyers on board in the options market. Again, the market is showing off strength. For sure, anything could happen. Next thing you know, something happened in Europe with Ukraine, and next thing you know, all this profit-taking becomes panic selling, and the market conditions change. Market conditions can change in an instant. So please do not take my words as financial advice or as a promise for the future. I'm just thinking like a trader, short-term mindset. There is an opportunity to find good stocks in an up climate for another 3 days. Statistically speaking, that makes a lot of sense. Hopefully, my explanation made sense to you. But you always need to attack the markets with risk management, risk under control, setting your entries and your exits in ways where if you're right, you maximize your profits, but if you're wrong, you minimize the loss, instead of falling into a hoping territory where now the market goes against you and you're hoping, please come back, please come back. We should never do that, because while we have a good market condition in front of us, it's just a market condition. It's just statistics. Statistics could be broken any moment in time. Okay, so just keep that in mind. Okay, for sure, some of you are more experienced than others. I expect some of you attending the session today have been trading for a while. I also expect that some of you attending the session may be new to trading. So probably it's a mix. So I'm always concerned when I do a market analysis session that maybe I get you excited to trade and you don't have a trading plan or things of that sort. So just make sure you are well prepared with your plans when you trade. And no matter what I said, no matter what anyone says, make sure that you know where you enter, you know where you exit, you know how much money you use per trade, you know how much risk you are willing to take per trade. Maybe you want to risk $100 per trade maximum, maybe you want to risk $1,000 per trade maximum. Whatever that is, make sure all of this is under control on your side, because the fact that we have a strong market condition is exciting, but it doesn't mean it's a guarantee. Okay, so make sure that you guys keep your risks under control via implementing a trading plan with discipline. Okay, cool, my friends, I'm done for today. 1 minute late. If there is any extra question, for sure I can take it. If there are no more questions, then we will say goodbye. But for sure, I'd like to get a final feedback from you, everyone. So please do not go yet. Just let me know how it went, even if it's just a quick okay or a quick okay bye. I'll take that happily. But at least hearing from you will certainly be something I would appreciate. And also, by the way, if you have a different opinion than me, or you have seen some market data that suggests otherwise, and you want to share this with the community, for sure, this is a community, right? So go ahead and type it in. I am a trader, and while I know what I'm doing, sometimes I'm wrong because I'm a trader. So maybe something I don't. And certainly, trading makes you humble. So I'm certainly happy to hear your opinions, which could be different than mine. And doesn't mean I'm a better trader than you or you're a better trader than me. We are both traders. So be happy to share if you have any opinion or any question or just a quick okay or a quick bye. That would be nice to hear. So I'm just going to wait for those comments. Thank you for that, Cecilim. Wonderful. Perfect. Okay, so my friends, I believe that we are done. I'm just gonna complete the session here. Thank you so much for attending. As always, I also want to thank Tiger Brokers for organizing these sessions, for notifying the event so you guys know when to come and when to participate. Also for their kindness on supporting the whole community of traders. So thank you so much, Tiger Brokers, and thank you all. And if you're watching this recorded, thank you to you too as well. And if you are watching this live, especially if you are watching this live, join me in 2 hours plus, 11 p.m. Our time here in Singapore. I'll be doing options trading live. So use the link on the screen. Do it quickly so we got time to enable your username. and that way you have access to the trading room at 11 p.m. and we can then, apart from talking about options pricing models, we can actually put trades together and actually take the trades, okay? Because I'm going to be executing trades. So see you then. You guys take care. See you soon. Bye-bye.